There seems to be just an uncertain element hanging over the US political landscape. And I think the risk from that are just not only isolated to the US, but I think this could present global risk, especially in equity markets. Stephen Innes, OANDA. On Tuesday, the Reserve Bank of Australia left the cash rate unchanged at a record low of 1.5%. The RBA said the strength of the Australian dollar is expected to contribute to subdued price pressures in the economy. Do you think this was the RBA hinting that they will reduce their growth forecast for Australia?
Yeah, I think by all writing that's been on the wall, given the Governor Lowe and Assistant Governor Debella have been doing their best job on routine on the Aussie dollar for the past couple of weeks, it certainly seems that their concerns are found with the strengthening Aussie dollar, which has really caught them unexpected. But, we look at the RBA, they've continued to point out concerns regarding low wages. They've talked about labor underutilization. And, I think what this adds up to be is that the RBA are going to not withdraw monetary stimulus this year. Today's statement on monetary policy, the bank, in fact, dropped their GDP growth targets from 2.5% to 3% to 2% to 3%, and they were definitely indicating that the pressure points that they saw were definitely exchange related. I think what they're also really looking at, though, down the road here, there is a bearish case for the Aussie dollar, but it boils down more to a macro level. So if we just want to use a loose analogy here, you look at the current macro state, which is basically a credit bubble, and where most of the export markets are derived from is from an iron ore mine. So if we get this cyclical bearish narrative filtering through the commodity markets, the RBA might get a little bit lucky, and the Australian dollar may weaken off in that regard.
And Stephen, the ADP and Moody's Analytics said US private employers added just 178,000 jobs for the month, which was below market estimates. These weaker figures are looming over NFP data out this week as well, as they point to a possible slowdown in the US labour market. What do you make of these figures?
Well, I think if we see a significant slowdown in the labor market, it'll obviously weigh negatively on the U.S. dollar. Then on the top side, I don't think there's going to be that big of a change in the narrative from the Fed narrative, even if it comes out above expectations. I think what the market's really keen on today is the all-important wage data, and that's going to come under the market glare. But, if I put the crystal ball assumptions aside here, one thing that current price action is really suggesting that this month's headline is going to be very unlikely to change the Fed view. And it's definitely going to come down to perhaps a keener expected rise on early earnings. So my view is, even if we get an unlikely bounce on the U.S. dollar post-NFP scenario, traders are probably going to be more inclined to fade this dollar strength. So, in my view, I'd be looking for any dollar rallies to be selling into the market.
And the Governor of the Bank of England, Mark Carney, has warned that uncertainty over Brexit is already weighing on the economy, as the bank voted to hold rates and cut growth forecasts. Do you agree with the BOE's decision to cut growth forecasts?
Yeah, it's sort of, I guess it's not totally unsurprising. I mean, although we had some MPC members that were coming out expressing a more hawkish view earlier in the month, but I think there's just more at play than cutting growth forecasts. I think there's some discussion element of discussion that's surrounding Brexit uncertainty. And this must be playing into the broader picture. And, even given that, we've seen a downturn in investments coming into the UK because there's still, quite a bit of jitters. And we're also in a world where investments are actually circulating through the globe right now, but the UK is not picking up their share. So I think this is coming to the central bank narrative. And also, let's not forget the never-ending crisis in Washington's foggy bottom these days, where there seems to be just an uncertain element, hanging over this U.S. Political landscape. And I think the risks from that are just not only isolated to the U.S., but I think this could present global risk, and especially in equity markets. And I think this is why we're now seeing a little bit of tempering of rate hike expectations. Right now, by all accounts, it looks like the old ladies nailed down the rate hike window till at least second or third quarter in 2018. So, I think under that condition, I think the pound is going to remain particularly vulnerable against other G10 currencies, particularly against the crosses, Euro Sterling and Sterling Aussie.
Thank you for joining us today, Stephen, and giving your analysis on these key events. So that wraps up this week. We hope you have a lovely weekend, and we look forward to seeing you on Monday. Goodbye.